way I think about it is in three different categories. Tax can be relevant to ESG in reporting and transparency. This is probably the key one that everyone here listening in today is focused on, and it makes sense. If you think about reporting and transparency, those are the key building blocks to building trust and accountability. We can see here within the US, but also abroad, standard setters looking at expanding some of those disclosure requirements to include things such as your total tax contribution and the taxes that relate to your operations in each jurisdiction in which you operate. And often we think about tax as that one line item of income tax, but when thinking about your total tax contribution, it really does broaden and encompass some of those other things such as property tax, payroll tax, or environmental taxes. It provides an opportunity now for companies to take a look and see if these disclosures came in, how might they compare to their peers in the market, and is that in line with what they were expecting? The second category where I think there is a natural link between tax and ESG is in the area of credits and incentives or tax costs, or when thinking more broadly around value chain transformation. We see governments more often than not turning towards fiscal policy to help encourage behavior or discourage behavior. Most recently within Europe, we see carbon taxes, we see plastic taxes, we see increased restrictions on licenses, and all of these costs or benefits in the case of grants or subsidies or credits can really have an influence in how a company deploys capital throughout the group, or changes around how they may want to tweak their supply chain in order to enhance efficiencies. It's possible to help meet the goals of your ESG strategy by evaluating what the tax impact is or what the credits and incentives are. Then that can definitely help towards driving some of those synergies or increasing your return on investment. The final category where tax and ESG intersect is in deals. I think we all see this in the newspapers every day, the articles that come around. It's all about the green financing or the green assets or disposing of assets that maybe don't fit into the company's broader ESG targets or ESG goals. And it's something where tax can input into to help inform the decision as to the targets or investments that they want to make. We know with the fiscal policy, governments can introduce taxes to discourage certain behaviors. So whether it's carbon, plastics, or increased regulation, then that's certainly something to take into account in figuring out the return on investment or the value that you attribute to certain fixed assets. But they also have a lot of benefits and incentives. And so that may help drive some of the value or the synergies that you can get from those the targets that you're evaluating.